Let's kickstart the first conversation of the day, and this happens to this has to do rather with when to press the sell button on your investments with regard to your mutual fund scheme. Santosh Navlani, the Chief Operating Officer of ET Money, is joining in. Good evening to you, Santosh, and thanks so much for taking the time as always. Let's first talk about the recent performance of mutual fund schemes. We've seen a great deal of volatility in risk assets globally, and that's also the case here in India. How would you rate the performance in this increased volatility?
Hey Alex, I think it's pretty obvious to expect that if you're an equity investor, the volatility would have affected you the way it is in the markets today. So where markets are going down, you should expect that you would also be seeing a red in your portfolio. It depends whether the downside that you are witnessing in your portfolio is exactly same as the markets or higher or lower. That depends what kind of assets or what kind of investments you put in. But it is not going to be like a scenario where markets actually are going down and your portfolio on equity side is going to be going higher. Similarly, if you are a fixed income investor, then if you are somebody who is invested in the shorter duration of the curve or towards the shorter duration of the yield curve, you would have actually not seen a drawdown in the portfolio on that side. You probably would have made money. But if you're the long side or you've invested in long-term bond funds, you would have probably seen a red in your debt portfolio too. So I think it's pretty straightforward correlation that you would see in your portfolio. It's all kind of environment where equity has not performed, debt has definitely not performed the longer side, and of course gold has not gone anywhere for last couple of months as well. So typically it may not be a very rosy or a cheerful scenario being an Indian investor today, in my opinion. But I think if you have to take it in a stride and try to build a portfolio from in these times only for a long term to make money.
Okay, so then the question arises, where do you draw the line, right? Because you got to look at your mutual fund scheme's performance and you got to compare it obviously with a benchmark, but you also compare it with peers and see how the rest of the same mutual fund schemes or the schemes in that category are performing. So when do you decide whether or not to exit a mutual fund scheme?
So I think it depends on the when did you do the investment as an investor. If you are somebody who have been holding on to a fund for long periods of time, maybe 3 years, 5 years, and it has not been beating the benchmark or not being there in terms of beating the category average for last 2 years or so, I think it's time to kind of at least stop further investment in that kind of fund and maybe review the performance in a more broader manner. And if it means that the fund has not performed on the upside as well as downside during these last 6-9 months, it makes sense to exit that fund and put in a corresponding category, same category kind of fund category and put money there. And if you're somebody who's just started investing in the last 6 to 9 months, I don't think it makes sense whether the fund has been underperforming for a while or not performing right now. If you are somebody who chose that funds to 9 months ago, taking a belief about the fund's future potential, then I don't think it's time to panic or review performance. So it depends whether you've been with the fund for a while or you've been with the fund only in these recent times. And if you're somebody who's been investing in this fund for like long duration, for like 7 to 10 years, and you've been pretty good with the performance, last 2 years underperformance may not and should not bother you, at least from perspective that you made your money in the initial 5 years. And there are examples across these kind of scenarios where people actually face situations like this.
We were speaking at a time when there is a very large shift in the big managers, if you can call it, in the mutual fund industry. You have Prashant Jains that is exiting HDFC AMC, and he's managing a large amount of money. If you look at his track record over the past couple of decades, there have been periods of underperformance. I point this out because this is a great topic to talk about in the context of what we're speaking about today. There are people that have blindly trusted Prashant Jain. And they have benefited from that because though there have been periods of uncertainty or underperformance, that faith has been reposed over a period of time when he has outperformed as well. So, how do you judge? Do you judge the individual, or do you look at more factors than just the individual?
So, of course, Prashant Jain is one of the greatest fund managers that India has seen, Alex. And I think anybody who has been into mutual fund business as a intermediary or into research or media would have possibly allocated some amount of money to HDFC mutual fund equity schemes simply because of Prashant Jain. So I don't think one can take away from what he has been able to achieve for the fund house there. But I think you as an investor, we need to understand that the organization is possibly much more larger than the individual there. So if Prashant Jain has been at the helm for last 2 decades at the HDFC mutual fund, it's safe to assume that being a large organization, they have capable set of individuals, not just as one, but multiple people who are supporting Prashant Jain into multiple schemes and funds to manage them. So I don't think that Prashant Jain leaving has anything to do. And of course, I've read in media a lot of advisors actually saying that hold on to further investment Prashant Jain's or other HDFC mutual funds. I don't think that's the right way to look at things, because nobody as a single individual runs a fund, at least the large funds that HDFC mutual fund has. There's always an investment committee, people debate, people agree. There is always a house philosophy as well, not just an individual philosophy to run the funds. So I think it's futile to guess that just because Prashant Jain has gone, you should hold on to your future investments in that fund and only continue existing SIPs, or pause SIPs also and hold on to investments before seeing the performance over the next few months. I don't subscribe to that view at all.
So then let's talk about how to judge underperformance. First of all, you have to disregard, I would think, short-term underperformance, because obviously as an asset class, and we're talking about equity primarily here, as an asset class, you're talking about 5 years plus when you invest in equity, right? So one, you disregard short-term underperformance, but then what would you benchmark then for your decision to say that yes, my fund has underperformed the rest of its peers?
Yeah, so as we spoke in the beginning, I think most individuals, first of all, make a mistake that they don't compare the performance of their funds with the right peer set. They end up comparing a performance of a mid-cap fund that they're holding with a large cap, and large cap possibly has performed better in the marketplace and mid-cap has not. First of all, you need to get it right in terms of category comparison itself, that you are comparing your mid-cap funds, your flexi-cap funds, or your larger mid-cap or a large cap fund with the right category peers, and then taking a decision. That's number one. Second, at no point of time you should be looking at a performance in isolation. You should look at the short-term performance, the mid-term performance, and long-term performance. And one of the ways to look at that is basically look at annual rankings of these funds in the respective category. Second aspect is looking at how the fund has performed with respect to category peers in terms of trailing returns. When I say trailing, it means that last 1 year, last 2 years, last 3 years, and so on and so forth. And then third being that how the benchmark has done in the category. So if you are not very, very far from the benchmark, or not very, very far from category average, it may not really make sense to exit the fund. If the category average is, for example, -5%, you have fallen -6%, the benchmark is down by -7%. I think you cannot punish the fund manager just because it is down by extra 1 percentage point, because you want to know that the top category itself is -3. So I think it's all about relative underperformance that we need to understand versus looking at underperformance in absolute terms. Because ultimately, as an investor, you would need to check out what alternatives you have if you decide to move on from this fund. So alternatives also need to be looked at from perspective of how they are doing in terms of the compare that you have right now. So look at the right peer set, look at the kind of trailing returns, annual returns, ranking of the funds, how far away from the category average of the fund is, and of course whether the fund is needed at this point of in your portfolio or not. So if the fund is underperforming and it is no more needed in your portfolio, it becomes an easy decision, in my opinion, compared to when you need the fund in the portfolio or the category in the portfolio and fund is not doing good.
Okay. How important is the strategy or the approach or the philosophy of the fund manager and the fund house in understanding relative underperformance or outperformance of a mutual fund scheme? Because the reason I ask is that at certain points over the last couple of years, maybe a little bit more than that, value came into play in a big way. At certain points, even in the last couple of years, value kind of drifted away because valuations were stretched. And fund managers that pursue a value strategy were saying there isn't much value to be found. How important is it for the individual to understand the strategy that is being employed or the philosophy of the fund manager?
I think so. I wish it was easy for the end investors to understand this, Alex. I know people who are in the space possibly do a lot of research, not just on the returns and downside protection, but actually do qualitative research by reading fund manager commentary on a regular basis, understanding what kind of investing style the fund manager, whether it's growth, value, blended, or kind of some people also follow momentum or quality kind of approach to the portfolio. So I wish it was easy for the end investor to really first of all understand this entire aspect and also analyze as investors, and it's legibly a right kind of limitation that we all have, that we would understand that I as an investor have bought a large cap fund, a mid cap fund, or a large and mid cap fund. I would by definition be forcing myself to compare the fund manager on basis of performance, which can be downside protection as well as a return capture when the bull markets are there in the marketplace. So I think it's good to know that what kind of strategy your fund manager is following. But I'm sure that if value has underperformed and because of that your large cap has remained behind, you would not be married to value strategy for a long time. Ultimately, we all invest our money to earn returns from the portfolio. And if a fund manager is basically churning a kind of portfolio every 3 months, 6 months, and following the trend in the marketplace, whether value theme is working or quality is working or growth is working, and he is basically playing with the marketplace, he will generate returns for you. I don't think as an investors we actually get to know whether the fund manager is following a value philosophy right now to the hilt or a growth or all. So I don't think we have information at disposal as an investors to really analyze to that level. It's all about whether the fund is beating benchmark consistently or not, whether it is basically outperforming category averages or not. Is it in the at least a top half of the kind of category peers in the marketplace or not? And that's how I decide as a retail investor to stay invested. And I don't think I can expect more than that from an investor's behavior.
Then, from what you're saying, is the result is the performance of a mutual fund scheme in terms of the returns that they're able to capture over a period of time. But how important, you mentioned in the course of that answer, downside protection. How important is downside protection, and should investors, generally investors don't focus on that. They focus, of course, on whether or not we're beating benchmark, whether or not this is the top performing mutual fund on the upside. How important is downside protection?
I think it's one of the most critical aspect which sometimes gets overlooked, and hence at ET Money, if you go to our ET Money app and look up for any fund's performance, the first thing you will see is ET Money Fund Report Card, which is two components. One is performance quality, which is about returns with respect to the benchmark, on not just on perspective of absolute, but how it is performed against risk-free rate of return and what kind of risk has been taken, whether justified or not. And the second is basically downside protection. So if your fund is not protective on downside, you can't expect it to really give you upside consistently, because markets will always have ups and downs. There is no way the market will be a one-way trajectory on the upside. So when downside comes and your fund performs better and falls lesser, only then your fund will be able to basically outperform the benchmark again faster. Otherwise, if you fall a lot more, then even if you gain, the fact is you will not be able to catch up the category peers. Let's look at a simple example. Now, if your value of the fund that you are holding right now is rupees 100 and market correct by 20%, your fund basically falls by 30%, which is going to 70. So market has gone to 80, your fund has gone to 70. Market only needs to recover 25% to reach back to 100. But your fund would need to actually outperform almost by 45 odd percentage points. So it is far easy to bounce back by 25% than actually, kind of bounce back with 45%. So if you don't focus on downside protection as a fund manager, you would not be able to outperform consistently is how the numbers look like. So I think you need to focus as a lot on downside protection as a trait of fund manager, because ultimately investments is a risk management business first. Only when you are able to protect your money from risk, you'll be able to outperform. And returns are frivolous. They come in based on multiple uncontrollable factors, but risk is on your side, whether you can protect it or not.
Certainly, very well put. Santosh, thanks so much for taking the time. And of course, one would be able to look at periods of underperformance and also get something out of it, right? Because you're able to make better decisions based on the performance of your mutual fund scheme during periods of underperformance for the markets as a whole. Thank you so much, Santosh, as always, for taking the time.
Thank you.